Welcome to the Deep Dive, the show that really cuts through the noise and gets you straight to the heart of what you need to know. Imagine the scenario. You've invested in just a stunning property in Thailand, maybe a beautiful condo down in Phuket that's Phuket, and you're about to get that first rental payment. That initial thrill, of passive income is real, but then a question pops up, doesn't it? What about the taxes? So today we're going to demystify that exact question. We'll guide you through the crucial tax landscape so you can focus more on enjoying your investment, not stressing over the tax man. This deep dive is basically your shortcut to navigating Thailand's rental income tax. We're pulling insights from a really comprehensive guide published by Ocean Worldwide. They're a leading luxury real estate agency, and importantly, they've been based right there in Phuket since 2004. And this isn't just any agency. It's led by director Sandra O'Neill, and they're known for helping thousands of families and property investors over many years. They specialize in luxury residential real estate, not just in Phuket, but also Koh Samui. So they really, really know the ins and outs of this market. And their article, it just cuts right to the chase, making this whole complex world of Thai property tax, well, a lot easier for us to grasp. Our mission today is simple. Break down what you, as a landlord, need to be aware of. Doesn't matter if you're living in Thailand or investing from, afar. We'll cover the basics, what the tax authorities expect, how to keep everything above board. Make sure you don't feel overwhelmed by all the details. Okay, so let's unpack this right away. The guide starts with a fundamental truth, really. All rental income earned in Thailand, it's subject to tax. Doesn't matter if you're resident or not. If your property's here, the income from it, taxable. That's the baseline.
That's absolutely right. And what's really critical from the get-go is understanding how you're taxed. Because like you said, it's not a one-size-fits-all situation. The Thai Revenue Code, specifically Section 40, subsection 5, it clearly categorizes rental income. That covers long-term leases, even shorter-term holiday rentals. But the biggest differentiator, it's your residency status for tax purposes. That's key. So if you're considered a Thai tax resident, and that usually means you spend 180 days or more in Thailand within a single calendar year, then your rental income gets lumped together with any other earnings you might have, think salary, business profits, whatever. This combined total is then subject to a progressive personal income tax rate. It can climb pretty high, actually, up to 35%. And this is a really crucial point because it means potentially not just your Thai income, but maybe even your worldwide income could fall under the scope of Thai tax if you're deemed a resident.
Wow. Okay. Worldwide income, that's significant.
Right. It can be. Now, on the other hand, if you spend less than 180 days here, you're classified as a non-resident for tax purposes. In that scenario, you're only taxed on income earned within Thailand, so just the rental income from your Thai property. And for non-residents, let's see, the good news is there's typically a more straightforward flat tax rate. It's usually 15% on your gross rental income from those Thai property.
Okay, 15% flat rate. That sounds simpler.
It often is, yes. It simplifies things a lot for many foreign investors. And there's one more category. If the property isn't owned by you personally, but say through a Thai company, then the rental income falls under corporate income tax, or CIT. The rates there generally cap out at 20%. So the immediate takeaway, the most critical factor, is your tax residency status. That determines your liability and how your rent gets assessed. It's not just what you earn, but where you're considered to be living for tax purposes. That dictates the rules.
That distinction, resident, non-resident, corporate, that's really helpful. Sounds like the very first thing any landlord needs to figure out. Absolutely. Yeah. But okay, once you know your status, how do you actually calculate what you owe? You mentioned the Thai system for personal income is progressive, meaning the more you earn, the higher the percentage you pay on certain brackets of income. Could you sort of walk us through how that progressive system works for rental income? And I guess more importantly, how can you actually reduce that taxable income? Are there ways?
Yeah, great question. Because while, progressive rates might sound a bit daunting, there are very clear ways to manage your liability. Let's look at the general idea of these brackets for personal income. For instance, the first 150,000 Thai baht you earn in a year, that's usually tax exempt, 0%.
Okay, good start.
Yeah. Then income between 150,000 won and 300,000 baht is taxed at 5%. And it steadily climbs from there, 10%, 15%, 20%, 25%, 30%, until you hit income over 5 million baht. That portion is taxed at the top rate, 35%. So your total rental income isn't just hit with one single rate. It's kind of sliced up into these different brackets.
Right. Different bits taxed at different rates.
Exactly. However, and this is where things get really strategic, you don't pay tax on your gross rental earnings. You get to claim deductions. And these deductions can significantly reduce your taxable income. the simplest option. There's a standard 30% deduction on your gross rental income.
30%, just like that.
Just like that. So if you earn, say, $1 million baht in gross rent in a year, you can immediately deduct 300,000 baht. No receipts needed for that part. It leaves 700,000 baht as your starting point for taxable income.
That sounds convenient.
It is. It's popular for its simplicity.
Right.
And this is where good record keeping can genuinely pay off if your actual documented expenses related to the property add up to more than that 30%. You are absolutely entitled to claim the higher actual amount.
Ah, okay. So you need proof then.
You definitely need proof. Meticulous records are key. We're talking about things like major repairs, maintenance costs, I think replacing an air conditioner, fixing a roof leak, also property management fees, any advertising you did to find tenants, insurance premiums for the property, local government property taxes, even interest on loans you took out for the property's purchase or maybe improvement.
Right, all the real costs of running the property.
Exactly. The source gives a really clear example. Let's say you had a big plumbing issue, cost you 50,000 baht to fix, and your gross rent for that period was 100,000 baht. The standard deduction would only be 30,000 baht, but you can claim the actual 50,000 baht you spent.
So you save tax on that extra 20,000 baht.
Precisely. That 20,000 baht directly reduces your taxable income. What's really fascinating here is just how significantly these legitimate deductions can lower your overall tax bill. They could even potentially push your remaining income into a lower tax bracket overall. So keeping good records isn't just about, ticking boxes for compliance. It's a powerful strategic move.
Yeah, that makes perfect sense. Being organized isn't just about avoiding trouble. It's about optimizing your finances. Good point. So, okay, you figured out residency. You know how to handle deductions. What does this all mean for actually, doing your taxes, getting things sorted with the Thai Revenue Department? The article really emphasizes compliance is key. Sounds like good advice generally, but how do we actually practically do that?
Right. If we connect this to just being a responsible property owner, it really means understanding the specific deadlines and the procedures involved. The main event for landlords is the annual tax return. You have to report all your rental income from the previous calendar year. You use specific forms for this, usually PND 90 or PND 91. PND just stands for Personal Income Tax Declaration.
PND 90 or 91? Okay.
Yeah, PND 90 is typically if you have various income sources. Well, 91 is often for income mainly from employment, but it covers other types too. Generally, these are due by March 31st of the following year.
March 31st, got it.
However, there's also something called a mid-year tax filing requirement. It's known as PND 94. If you have substantial rental income coming in during the first half of the year, basically enough that it would trigger a tax liability, you might need to file this sort of provisional return around September.
Ah, like a prepayment.
Exactly. It acts as a prepayment, ensures you're not slammed with a huge bill at the year end. Now, missing these deadlines, it's not just a minor slip-up. It leads to fines, interest charges, and those can accrue pretty quickly. And deliberately avoiding tax, evasion, that can result in really hefty fines, potentially double the tax owed, plus serious legal action, possibly even imprisonment in severe cases.
Wow, okay. So timely and accurate filing is, cannot be overstated.
Absolutely.
What about for foreign landlords specifically? Are there any sort of unique aspects or common pitfalls they should be extra careful about when filing?
Yeah, definitely. Beyond the general rules, foreigners really need to pay close attention to a few specific points. We've already talked quite a bit about the 180-day rule for determining tax residency status. It's paramount.
Right, because it dictates worldwide versus Thai-only income tax.
Exactly. As a non-resident, remember, your rental income from a Thai property is considered assessable income source within Thailand. That puts it squarely under Thai tax law, that 15% rule usually. Crucially, though, to actually file your taxes and deal with the Revenue Department, every landlord, including foreigners, needs a Thai tax identification number, a TIN.
TIN, okay, tax ID number.
Yes, it's your essential identifier for all tax-related stuff in Thailand. You get it from the local Revenue Department office, usually in the area where your property is located. It might seem like just another bureaucratic step, but it's absolutely foundational.
Is it hard to get?
Usually not terribly hard, but the biggest hurdle people sometimes face is just making sure they have all the correct documents ready. Passport, property ownership, papers, things like that. It's always best to check the latest requirements before you go down there.
Makes sense. Prep is key. So it sounds like getting that TIN is step one. Now, the article then introduces a couple of concepts that might be new for some listeners: withholding tax and double taxation agreements. What do we need to know about those? How do they impact a landlord?
Right. These are interesting mechanisms. They're designed both to sort of streamline tax collection for the government, but also to prevent unfair burdens on taxpayers.
Yeah.
Let's break down withholding tax first, specifically on rental payments. This typically comes into play when your tenant isn't just an individual, but is a registered business or what's called a juristic person, basically, a company.
Okay, so if a company rents your condo.
Exactly. In that situation, the business tenant is legally required to withhold 5% of the rental payment directly from what they owe you. So if the rent is, say, 100,000 baht, they'll pay you 95,000 baht, and they hold back 5,000 baht.
And what do they do with that 5,000?
They have to remit that 5% to the revenue department, usually within 7 days of making the payment to you. Now, the key benefit for you, the landlord, is that this withheld tax isn't an extra tax. It acts as a prepayment. It's a credit against your overall annual income tax bill.
Ah, I see. Like the mid-year filing?
Kind of, yeah. So, for example, if your total tax liability for the year works out to be, say, 50,000 baht, but 20,000 baht has already been withheld by your corporate tenant throughout the year, you only need to pay the remaining 30,000 baht when you file your annual return. It's a system for ongoing collection. Makes the final bill less shocking.
Right. That's useful. Okay, what about the second one? Double taxation agreements, DTAs.
DTAs, yes.
Yeah.
Their purpose is exactly what the name suggests, to prevent you from being taxed twice on the same income, which can happen with international investments. Without these agreements, you could potentially pay tax on your Thai rental income here in Thailand and then pay tax again in your home country when you bring that money back.
Nobody wants that.
Definitely not. So here's how they generally work. The country where the property is located, Thailand, in this case, usually has the primary right to tax the rental income generated there. However, if you then remit that income back to your home country, and Thailand has a DTA with that specific country, you might be able to claim a credit for the tax you already paid in Thailand against your tax bill back home. Or sometimes it works the other way around depending on the specific agreement.
So it reduces your tax bill in one of the countries.
Essentially, yes. It reduces your overall global tax burden on that income. But, and this is really important, you absolutely must check the specific DTA between Thailand and your home country. Each agreement can differ quite significantly in its details, clauses, and exemptions. What works for someone from the UK might be different for someone from Australia or Singapore.
So you need to read the fine print for your specific situation.
Absolutely. And of course, keeping meticulous proof of the tax you paid in Thailand is crucial if you want to claim that credit back home. Overlooking a DTA can mean paying way more tax than you legally need to.
Okay, so withholding tax is like an advance payment credited back. DTAs stop you being taxed twice. Got it. That's a relief, especially for international investors. Now, beyond these sort of big rules, the article offers some specific insights, especially if you own a condominium, and then some overarching practical advice. How do these finer points and best practices help simplify things?
Yeah, this is where understanding the little details can really streamline everything. For condo rentals, specifically, there are a few key points. Firstly, those common area fees or management fees that you pay to the condo building, they are usually deductible against your rental income.
Ah, good to know. Keep the receipts.
Definitely keep those receipts. They're a legitimate operational cost. Secondly, renting out a condo means you also have to adhere to something called the Condominium Act. Now, this isn't directly a tax rule, but it dictates things like how units can be used, common area rules, and sometimes even restrictions on very short-term rentals like daily or weekly stays in some buildings.
Right, some condos don't allow Airbnb-style rentals.
Exactly. And if your building prohibits that, it directly impacts your potential income streams and therefore your tax situation. So you need to know your building's specific rules and comply. And lastly, your lease agreements. They need to comply with both the Thai Revenue Code and the Condominium Act. They should clearly state the terms and properly reflect things like withholding tax if your tenant is a company. A well-drafted lease prevents future headaches.
Okay, condo specifics noted. What about the more general practical tips, the big takeaways for managing tax effectively?
Right, moving to the broader advice. The number one most vital step, and I really can't emphasize this enough, is maintain meticulous records. This means keeping clear, organized records of every single baht earned from rent and every single baht spent on the property.
Everything.
Everything. All rental agreements, bank statements showing the income and the expenses going out, all receipts for repairs, management fees, insurance premiums, advertising costs, you name it, store them safely, whether that's digitally in the cloud or in well-organized physical files. Just think. Missing one receipt for a large repair could mean paying hundreds, maybe thousands, of extra baht in tax unnecessarily.
That's a very tangible reason to be organized.
It really is.
Yeah.
Secondly, Don't hesitate to seek expert tax advice. Thai tax law can be intricate, especially for non-locals who might not be familiar with all the nuances or, frankly, the language. Consulting a qualified tax professional, maybe an accountant who specializes in Thai property tax, it's highly recommended. They can ensure you're compliant, help you maximize every eligible deduction, and navigate complex situations like having income in multiple countries or dealing with specific ownership structures.
So professional help is worth the investment.
Often, yes. A good advisor doesn't just fill out forms, they offer strategic planning. The cost of their advice usually pales in comparison to potential fines or missed deductions.
Good point.
And finally, always stay informed on regulatory changes. Tax rules aren't static. They can and do change. Keep an eye on announcements from the Thai Revenue Department. Maybe subscribe to updates from reputable tax advisory firms. This way, you'll know about any new deductions, changes in tax rates, or maybe revised filing procedures before they catch you by surprise. Adaptability in your tax planning is really key.
That's incredibly practical advice. From the specific condo details right up to the big picture importance of documentation and getting expert help, it really underlines that while the system might seem complex from the outside, with the right info and the right approach, it's actually entirely manageable. So there you have it. We've seen that renting out property in Thailand, especially in these amazing spots like Phuket, or Koh Samui, definitely comes with clear tax obligations. But, it's not an insurmountable challenge. Understanding your residency status is step one. Then strategically leveraging deductions, whether it's that simple 30% standard deduction or meticulously claiming higher actual expenses. And underpinning it all, maintaining those meticulous records, that's your best defense against tax headaches. It really boils down to being informed and prepared. Now, looking ahead, the world of real estate investment is constantly evolving, isn't it? We see new tech shifting global economic landscapes, changing regulations all the time. For a property owner in Thailand, or really anywhere internationally, understanding your tax obligations isn't just a one-time task. It feels more like an ongoing commitment to adaptability. So a final thought to leave you with: what new considerations might pop up in the future for global property investors, maybe driven by things like digital currencies or stricter international financial reporting, or even changing tourism patterns post-pandemic? And how can staying informed really keep you not just compliant, but maybe genuinely ahead of the curve? Something to think about. We encourage you to keep exploring, keep learning, and definitely keep asking those deep questions.